for the unique in the unique program of actuarial valuation. I think this is a unique subject. Many of the CA we don't know about what is actuarial valuation and why it is required, when it is required, to whom it is compulsory. So we have here Kartikey, but before that I want you to put your I want to request you all to put your hand on your heart for our institute motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. Sorry. So now we will start with our topic. But before that, we want to welcome our WIRC Secretary, C. Sweta Jain. Welcome, Sweta, in our webinar. I want to request her to give some opening remark for the session. Over to you, Sweta.
Thank you so much, Pinky. So first, let me thanks to our speaker today, Kartikey Kandoi sir, for accepting our invitation and giving your valuable time. So thank you so much for coming and joining us today. So on behalf of Western India Regional Council, let me take the privilege to welcome all of you on this program on actuarial valuation and employee benefits. So welcome you all, and I'm really happy to see you all joining in a large and huge number. So thank you so much. Friends, after World Congress of Accountant, the Indian Chartered Accountant has presence our mark globally. And there is no doubt about it that Indian Chartered Accountant image is very high, even across the globe. So a lot of new opportunities are knocking the door. It is all up to us that how we can grab it. So friends, my request to all of you is please be updated with latest technology and knowledge, because technology is way forward and everywhere it is playing a very important role. And our profession is also no exception to it. So sooner or later, we have to adopt the technology in our work also. So for WIRC this year, a lot of initiatives under the able leadership of our chairman, CA Murtaza Kachwala. This year, we have a lot of new initiatives have started, and our major focus was on technology and ethics and audit. Because without technology, if we want to grow, it is like it's not possible, we can say like that. So this year we have started a technology drive, which is a 5 days in a month. The series which we have started, Excel, Tableau Fusion, be it artificial intelligence, Python, Tableau, robotics, automation process, blockchain technology, and how we can use this technology in our work. So simple workshop has been organized and we are doing in future also. You will find all the details on, in our WRC website also. Then second, lot of refresher courses also we have started, because if we want to increase efficiency in our work, So in-depth knowledge is definitely required, and we have to update it with the changes also. So keeping this in mind, this year, lot of refresher courses on internal audit, cooperative society audits, forensics, something like that. So this year, a lot of workshop and refresher courses also we have organized. Coming also auditing standards, accounting standard. So this series is also continuing. Again, all the details are available on the RWRC website. So friends, of course, we need your participation and support to achieve our goals. But at the same time, we all are there to support you also. So if anything is there, any suggestions, any feedback, please feel free to contact us, to reach out to us. So we all are available. Our cell numbers and all the details are available on the website also. So with this, I would like to conclude my words here. Thank you so much, Pinky, for giving me this opportunity to interact with the members. And now, please go ahead for further proceedings for the webinar.
Thank you, Sweta, for giving update to our participants that what we are doing at the institute level, because many of the participants are not aware what we are doing. And so thank you, and it's our privilege to listen to you. So now we don't want to wait CA Kartikey. So I want to formally introduce Kartikey to our participant. Mr. Kartikey is a fellow actuarian of India, UK and Sri Lanka. He is a fellow chartered accountant also. He is a council member of Institute of Actuarian of India. He is also secretary to Advisory Committee on Pension, Other Employee Benefit and Social Security of Institute of Actuarian of India. He is an actuary and chartered accountant. He has specialized in the employee benefit domain. He provides actuarial, accounting and advisory services across the industry. He is the founder member of and proprietor of the firm Messrs. Kandoi and Company. And he had the privilege of working with Messrs. K. Pandit Consultant and Actuarian for 8 years, including 5 years post-actuarian qualification and 3 years with Deloitte for CA articles. His key achievements are very interesting, that he has secured a 15th All India rank in CA-IPCC and 99 marks in accountancy in CA-IPCC. So it's very, first time I had heard that CA में 99 marks आना, it's a very
really great. Yes.
Really great. It's and he's also India topper for special technical employee benefit and pensions actuary. He is India topper for core application modeling and documentation actuary. One of the youngest fellow actuarian in India. He is qualified at the age of 24 years. Wow, great. And now he is the youngest actuary to presently serve as Central Council member of the Institute of Actuaria of India. Faculty for certificate courses on Indes by ICAI. He is also faculty for deep dive courses on share-based payment, faculty for actuarial service in Mumbai University. So we have so talented faculty with us to guide us on the actuarial valuation and what is actuary valuation, when it is required, why it is required. So Kartikey, I request you to take the session and guide us on this matter. And welcome you, sir.
Thank you very much, ma'am, for the kind words. And first of all, I would like to thanks to the WARC team for organizing this session, and also to our participants who have registered for this session and are attending this session. So with this, let me share my screen. Just to check whether my screen is visible and the audio is also clear.
All perfect.
Okay, fine, perfect. So with this, today we have the topic of actuarial valuation in employee benefits. And for that, we have two key accounting standards. In the IGAP, we have AS 15, and under Ind AS, which is similar to IFRS, we have the Ind AS 19. So we will be talking on these two standards, the accounting aspects as well as the auditing aspects, because our members can be playing the role either as a CFO, finance controller, or they can also be in the practice and playing the role of the auditor. So with this view, we will be covering both accounting and the auditing aspects of these actuarial valuations. And in my background, you may be seeing the letter of A, so that A will denote both accounting, actuaries, and auditing. So that's why we have that background image. So that's one of the point. And so while we discuss today on this topic, first we will have the introduction to actuarial valuation. What is the importance of actuarial valuation? Why it is required? To which category of companies this actuarial valuation is required or not? Then we will cover the regulatory aspects of the gratuity and leave, because these are some of the common benefits being given to the employees of various organizations. What are the provision requirements in the accounting standards for the same? We'll also cover the actuarial valuation assumptions, because this valuation is based on the assumptions. So how these assumptions are set, they can be checked by the auditor, they can be relooked by the management, so that we will discuss in detail with the examples that how the assumptions play a key role in the actuarial valuation. We'll also see the calculation example, because many times it is believed by we chartered accountants, auditors, that actuarial valuation is a black box, that whatever goes in the valuation we don't understand, and what we get is the report. So I will try to unbox this black box, try to make the calculations more transparent, more clear. So that should be helpful to us while doing the audits and accounting of the same. We'll obviously cover the practical aspects in actuarial valuation from the auditing angle. So these are some of the things there in my mind. So you can type your answers in the Q&A or chat section as we go along. I will try to address them as we go. Otherwise, we can take the Q&A at the end, whatever is remaining. So with this, let us first discuss on the classification of employee benefits for the AS 15 as well as Ind AS 19. So if we talk about the classification, it is same in the Ind AS 19 as well as AS 15. The standard have bifurcated the benefits in 4 types. The first is the short-term employee benefits. As the name suggests, in this kind of employee benefits, benefits are paid to the employees in the short term. Short term means the 12 months from the reporting date. So let's say we are paying the salary for the month of March in the month of April. So this is a kind of the short-term employee benefit, and this is to be also accounted as per the AS 15 or the Ind AS 19 only. We may have the short-term compensated absences, like the company may have some leave policy where the carry forward of leave is allowed in the next year only. After the next year, they may either lapse the leave or they may encase the leave towards the end of the year. Like the carry forward is not allowed beyond the 12 months from the reporting date. Then it is classified as a short-term employee benefits. The another type of short-term employee benefit is the short-term profit sharing or the bonus plan. Like companies pay the annual performance bonus. So these performance bonus are kind of the short-term payouts, like we are paying it immediately in the next 2 to 3 months of the end of the financial year. So these are some of the examples of the short-term employee benefits. And the accounting standard says, while we do the provisioning, this short-term benefits, we need to account for the expense when the service is rendered. And how do we make the provision? It is based on the expected amount that company is going to pay for this amount. For example, we are making a provision for the bonus. So the provision for bonus will be done as per the amount what we expect to pay for the bonus in the coming months. For the short-term benefits, there is no requirement of actuarial valuation because it doesn't involve any actuarial assumptions. So the standard is very clear on this aspect that short-term employee benefits, they doesn't require any actuarial assumptions, they doesn't require any actuarial valuation. Then comes the post-employment benefit, which is the critical part of the AS 15 and the Ind AS 19, where we have the defined benefits. So in the defined benefits, we have the benefits like gratuity, which is paid to the employee when they complete the 5 years of service and they leave the organization or they retire from the company. So this is one benefit which is payable in all the organizations. So another example of defined benefit is pension plan, post-retirement medical schemes. So in this kind of plans, they are classified it as a defined benefit scheme, because in these plans, the risk of the final expected payment and the investment risk falls on the employer. But contrary to this, we may have some defined contribution post-employment plan where benefit is paid to the employee after the employment. And the example could be the EPF contribution with the EPFO or NPS contribution by the company, where the contribution amount is fixed. Like there is no uncertainty on the cost of the company. So these are classified as a defined contribution plan. Again, if we talk about the accounting of the same, then accounting of defined contribution plan is quite simple. It doesn't require any actuarial valuation for defined contribution plan, because the standard says whatever is the cost of the year under the defined contribution plan that you account for as an expense as the service is rendered. But when it comes to the defined benefit plans, it requires the use of various actuarial assumptions, the use of one method which is prescribed as projected unit credit method. So that's why for this kind of plan, standard says we require the actuarial valuation. We'll discuss this in detail, but first we are talking on the classification of employee benefits only as of now. The third important classification which we have is the other long-term employee benefit. So the other long-term employee benefits are the benefits which are paid beyond 12 months from the reporting date, but before the employment, because for post-employment, we have the separate classification. So this is the third classification where benefit is paid before the employment, but after 12 months. So what can be the example of other long-term benefit? There can be some benefit of the, let's say the gold coin. That company have the scheme where they pay gold coin once employee completes service of, let's say, 3 years or 5 years or 10 years. So basis that they give them gold coin of, let's say, 5 gram, 10 gram, 15 gram or so. So this is a kind of a benefit which is paid in the future to compensate the service in the past. Okay, so this is one example of other long-term benefit which is covered under the AS 15 and Ind AS 19. Other type of employee benefit which is classified as other long-term is your leave policy, where company allows you a leave in a particular year and we carry forward these leaves in the future up till the retirement or separation from the company, and then it may be encashed, it may be utilized. So these leaves are classified as a other long-term. The standard says for other long-term benefits also, we need to do the provision as per actuarial valuation. The PPT will be provided to all the participants and it will be available on the WRC website. If we talk about the one question on the DC pension, which is over here as a defined contribution plan. So DC means defined contribution. So the pension over here, what we mean is it is similar to the NPS. So let's say company may be having their own voluntary pension plan and they want to contribute some amount to that pension plan every year. And at the end, whenever employee retire from the company, they get some pension amount. Okay, so what is important in the defined contribution plan is the whatever contribution we make every year on year, it is contribution is fixed. It may be fixed as a percentage of the salary, and we are not paying the any amount in the future to compensate if, let's say, the final pension is low or high. So all the risk of the actuarial risk and the investment risk, they are on the employee in case of defined contribution plan. Now we're moving on to the fourth classification, which is the termination benefits. The termination benefit, as the name suggests, these are some benefits which are paid when the employees are terminated or they get separated, and we pay some compensation. The example is like the VRS scheme, where we may be paying some compensation amount. So again, for the termination benefits, it doesn't require any actuarial valuation. The accounting is quite simple. The expense needs to be recorded when we announce that plan, or the restructuring cost is recorded as per the Index 37 for the termination benefits. Today's our discussion is mainly on the actuarial valuation in the employee benefits. So the major discussion will be revolving around the post-employment plans, which is in the nature of defined benefit, and the other long-term plans, because these are the two benefits which requires the actuarial valuation. So if let me launch a poll to understand our participants. So the question is, have you earlier came across some Index 19 or the employee benefits actuarial valuation report? So we understand that the distribution of our members. So accordingly, I will moderate my talk as I go along. Let us give 1 minute for our members to select the answer. Okay, so we have evenly distributed numbers, like exactly 50% members who are new to this topic. They have never faced or never seen any actuarial valuation report as per AS 15 or Index 19. And we have 50% participants who have earlier came across this kind of reports. So with due respect to both type of members, we'll moderate my session accordingly. And I hope that now our perspective may change, that whether we require the actuarial valuation or not, and the significance of that. So maybe after the end of the session, this number may undergo change if we talk about the actuarial valuation reports. Okay, so let us understand why this actuarial valuation or this AS 15 is very important to we practicing chartered accountants for the finance management in the company, maybe the CFO. If we talk about, so this graph is taken from the Financial Reporting Review Board. They had published one booklet on the deficiencies or incompliances in the various accounting standards. And this is one summary they have prepared as a graph, that which AS have the highest issues or highest number of companies where they found the deficiencies in the AS compliance. So it is unfortunate to say that AS 15 is on the top list in that, after the AS 3, where they found the maximum non-compliances in terms of the accounting by the company, provision by the company. What are these non-compliances? How they can be solved? Because after this session, we don't want that our companies, wherever we are doing audit, wherever we are doing accounting, they should have this kind of non-compliance. With this objective, we will see that how we can mitigate this, because talking about non-compliance is one part, but talking about the mitigation is very important. So that we will see. So related to this, we need to understand that which type of companies requires the actuarial valuations. So we have one more poll question to understand that how our members believe as of now First, let us understand the question, then select your answer. Please don't hurry in giving the answer. So we have one company with the number of employees more than 10. And so as the number of employees are more than 10, the gratuity is applicable to them. The question is whether they are required to make the provision for this gratuity as per the actuarial valuation PUCM method or not. For which kind of category it is required. The number one is listed company only. The number two is the non-SMC. Non-SMC includes the listed companies and the companies who have turnover more than 250 crore or borrowing more than 50 crore. The third one is the SMC as well as non-SMC. So SMC means the small companies having the turnover less than 250 crore, borrowing less than 50 crore, and which is not in the non-SMC criteria. So with this question, please select your appropriate answer. Because if this classification is clear to us, then the more than 50% of the issues which are identified by this financial reporting review board, they will be solved. Because sometimes we chartered accountant may not be aware that whether this kind of provision is required by our company or not. It is required by our client or not. So let us see the answer of our members over here. So 40% of our members believe that this kind of provision is required only for the listed companies, whereas 40% of members believe it is required by all companies, whether small and medium or non-small and medium, and 16% believe it is for non-SMC companies. Now let us evaluate what our accounting literature or the announcement by the MCA says on this topic. So let us go through this. So in AS15 and Index 19, as we are talking first on the AS15, we have these four classification like short-term, post-employment, other long-term, and the termination benefits. So these are the four classifications we have. So if we talk about the AS15, it says that provision for all these benefits, it is required by all the companies, whether it is a short-term, other long-term, or post-employment or termination benefit. If any amount is outstanding as on the reporting date, if it is payable by the company, we need to make the provision. So the standard is very clear. Provision needs to be made by every company. The question is how this provision to be made. Whether this provision requires the actuarial assumptions, this projected unit credit method, involvement of actuary, whether it is required for which kind of benefits. So the standard says for short-term benefits, actuarial valuation is not required because there are no actuarial assumptions. Similarly, there are no detailed disclosures for the short-term. The disclosures are very minimal for the short-term benefits. It is like the expense amount and the nature of benefit, but the detailed disclosures are not required. When we comes to the post-employment defined benefit plan, which is your like gratuity benefit, which is applicable to all companies having more than 10 employees, the standard says it requires the provision as per PUCM method by all these companies, whether it is a small and medium company or it is a non-small and medium company. They all require the provision as per this PUCM method. What is exempted for the small and medium company is the detailed disclosure. The small companies means the turnover less than 250 crore, borrowing less than 50 crore. This company, they don't need to give the detailed disclosure, but they need to make the provision in the accounts as per the actuarial valuation PUCM method. The link to the definition and all the announcements are given in this presentation file along with the reference and the page number, so that we may read later on. Let me show the definition also, like definition of the SMC and the non-SMC company. So this definition got updated in 2021. Earlier the limit was less, now limit has increased to turnover being 250 crore and the borrowing being 50 crore. So based on these definitions, the key conclusion over here is for all the small and medium companies, whether it is small company or the large company, for all the companies, we are required to make the provision in the books of accounts as per the actuarial valuation, which is the actuarial assumptions and the PUCM projected unit credit method. Only thing which is exempted for small companies is the detailed disclosures. So they are exempted from that 2-3 pages long disclosures. They only need to disclose the provision amount and the key assumptions. This is what standard requires. Moving on to the third benefit, which is the other long-term benefit, the standard says for every company, whether it is small company or the non-small company, they need to make the provision, and there is no requirement of detailed disclosure. Like your benefits plan, like leave encashment or long service award. For these kind of benefits, the detailed disclosures are not required. It is given under para 132 of AS 15. But it requires the use of all actuarial assumptions and the projected unit credit method. So this needs to be done as per the actuarial valuation for the other long-term benefits as well. For termination benefit, there is no use of actuarial assumptions and there is no detailed disclosure required. The PUCM stand for the projected unit credit method. So why the standard have described this method? Because we actuaries have the 4 different methods for calculation of the provision. For example, in the depreciation, we have 2 methods, straight line method and the WDV method, which is the written down value method. Similarly, in actuaries, for the calculation of any provision or any actuarial liability, we have 4 different methods which are studied in the actuarial curriculum. So PUCM is one of those 4 methods which is primarily based on the accrual concept. So that's why this method is adopted by the IFRS, US GAAP, as well as the Indian GAAP. Indian GAAP includes both AS 15 and the Ind AS 19. So now it should be clear to all our participants, to all our members, that whether company is a small and medium company or it is a large company, irrespective they are listed or unlisted, they require the actuarial valuation provision. Because the maximum issues which are found by the FRRB, Financial Reporting Review Board, they were with regard to the point that company have not made the provision of actuarial valuation, they have not disclosed it properly. So if it is clear to us that yes, it is required, then it is good to go. Now let me go through some of the Q&A we have. Yeah, they need to make the provision for actuarial valuation. Every company need to make the provision for actuarial valuation. There is a question whether for the non-profit organization, they need to make the provision and actuarial valuation or not. So the thing is, as of now, on this slide, we are talking about the companies. Now we will talk about the non-companies. Okay. So if your organization is a non-company entity, as per the accounting standards classification, if it is a non-corporate entity means the private limited or the limited company or the listed or unlisted company, you can say. But if your organization is not a company structure, they are the entity, means let's say the proprietor, partnership firm or LLP. Then the difference is for the entities, they need to follow the accounting standards given by the ICAI. But for the companies, they need to follow the accounting standards given by the MCA. Okay. So when we talk about the entities, the organizations where they follow the standard given by the ICAI, we have 4 different classification. Level 1, 2, 3, 4. The 4 being the micro entity, this is the large company, and this is the small, medium, and this is the micro. So The standard says for these 4 different classification of companies, if we talk about the provision for the actuarial valuations, like gratuity and leave, both the post-employment and the other long-term plans, the standard says if the company have number of employees more than 50, in that situation for these entities, we need to make the provision if they fall under the level 2, 3 or 1. If they are in level 4, they are exempted from the actuarial valuation. And if they have the employee less than 50, then even if they are in the level 2 or 3, they are again exempted. So this is what standard says. The link of the same is given over here for the notification. And the detailed disclosures, they are exempted for the companies. So the point over here is, if it is an entity, and the definition of level 2, 3, 4 also, it is again based on the turnover and the borrowing, which is given as part of the appendix to this presentation. Let me just quickly show that number. The numbers you can see later on, but the point over here is the level 4 is based on the turnover less than 10 crore and borrowing less than 2 crore. So for the level 4 entity, they don't require the actuarial valuation involvement. And this is for the entity. So please remember the difference of company and the entity, because the same auditor can have both clients. Like they may have some of the clients in the partnership firms or LLP, they may have the limited company clients or the private limited company clients as well. So this is for the entities, and the previous one was for the company. So that's the key difference over here. If we talk about the entities where the benefits are exempted, the question comes, let's say this entity level 4, the actuarial valuation is exempted. The question is, are they exempted from the provision? No. They also need to make the provision, but that provision can be made without involving any actuarial assumptions, without involving actuary. It can be done by some other rational method, which is prescribed in the standard, which says that you assume that all the benefits are payable on the reporting date. Based on that assumption, we have to make the provision for the situations where the compliance of standard is exempted. So this is all about from the compliance side. Yeah, level 1 means the large company, and 2, 3, 4 as we go along, it is small, medium, and the micro. And remember that this is only for the entity, and previous one was for the company. So with this, let us move further to the Ind AS part, because AS had various non-compliances in AS 15. Let us see about Ind AS compliances by the FRRB reporting. So they say that Ind AS 19, again, they have various non-compliances, but now some of the new Ind AS which are introduced, which are not in the AS regime, they have the more non-compliance because they are coming for the first time. So that's why they have more non-compliances. But the non-compliance in the Ind AS 19 again remains, which may be in the similar nature which are there for the AS 15 companies as well. So we will discuss this actually what are the non-compliances found by the company in detail when we cover the practical aspect. I hope this is clear to our members. With this, let us move further with this summary chart for the Ind AS compliances. So if we talk about the Ind AS 19 companies, if you are auditing is under the Ind AS regime, then there is no such exemption is available for the which was there for SMC, non-SMC, level 2, 3, 4 companies, organizations you can say. So any organizations, once they are under Ind AS compliance, there is no exemption, no partial exemption from any Ind AS. Ind AS is applicable in full. So what Ind AS says, we have to make the provision as per the actuarial valuation and detailed disclosure for the post-employment plan. But for other long-term benefits like your leave or long service award, they only require the provisions as per the actuarial valuation, but the detailed disclosures are exempted over here. So I hope this is clear to everyone. With this, let us move on to the regulatory requirement specific to the gratuity and leave and its provision. And also, while we go along this, we will cover the answer of some of the members that whether company needs to make this kind of provision if they are the new company. Let's say company is having service less than 5 years only. Then whether we need to make the provision or not. So that all these aspects we will cover now when we talk on the regulatory requirements. So first is gratuity is applicable to all organizations when we have 10 or more employees. It is classified as a post-employment plan. Leave is classified as a other long-term plan, and it is governed by the Shop Establishment Act of the respective states and also by the Factories Act if your organization is registered under the Factories Act. So these respective state acts under the Shop Establishment Act and the Factories Act, it gives the criteria of what is the number of leaves you need to credit for a year, whether we need to carry forward the leave or not, whether we need to encash the leave or not. So all these things are given and driven by the Shop Establishment Act and the Factories Act. Then the third point, which is very important and raises the question to various of our auditors friends, that whether we need to make the provision if the service is less than 5 years in case of gratuity. The answer is yes. We need to make the provision even if service is less than 5 years. The reason for this is in Ind AS 19 we have para 72, and in the AS 15 we have para 70. Both of these paragraph speaks that if employees have service which is less than the vesting period, which is the 5 years in our case, then also we need to make the provision for the service which is already rendered to the company. But while making this provision, one needs to allow for the future attrition rate. Like, for example, if your service is 2 years and you have to complete total 5 years to stay in the company, and for example, let's say the attrition rate is 10% per annum, then what will happen? We need to make the provision for only 70% chance. If I talk broadly, the actual calculation, how it works, that we will see later on when we go to the practical numerical example. But if I have to tell you very broadly, without using much of other assumptions, then standard says in the para 70 and in the 72 of Ind AS 19 that we need to make the provision even if service is less than 5 years, less than vesting period. Another point is that both the standards requires the companies to ensure that provision is made as per the projected unit credit method, which is the PUCM method. And then both AS 15 and Ind AS 19, we have the requirement of detailed disclosures in the notes to account. And as we discussed, these disclosures may be exempted for the SMC level companies or some of the known entities which are under the level 2, 3, 4. But otherwise, for large organizations, the disclosure is mandatory. So we need to ensure that wherever it is mandatory, it needs to be complied by the company, and the auditor needs to ensure that. Let me have a look at the Q&A section also. There is a question that whether actuarial valuation is applicable for association and trust. Yes, it may be applicable if they have that criteria of turnover, borrowing, level 1, 2, 3, 4. So if they are preparing the accounts as per the accounting standards, so what usually happen in case of, let's say, the associations or the trust, they may not have the number of employee more than 50. So if you remember our previous discussion, if the number of employees are less than 50, and even if you are in the level 2 or 3, then it is exempted. So we need to check both conditions of the turnover borrowing plus the condition of the number of employees. And what used to happen as we chartered accountant students, we usually refer to the AS which is downloaded from the ICI website. So one thing I would like to tell you, the accounting standards which are available on the ICI websites, they are mainly for the entities purpose. So if you download the accounting standard from the MCA website, they will be only applicable to the company. So there you will find that difference of 50 employees and not 50 employees mentioned over there, because the ICI standard may have some language where they may have wording for both, like companies and the entities. So one may get confused in the number of employees being mentioned of 50 over there. So if you are checking the document and referring to the companies, then we must see the MCA link rather than the ICI link, to not to get confused. Yeah, detailed disclosures are mandatory to give in the notes to account if it is applicable. If it is not exempted, you can say, because the standard says if your entity is taking the exemption under AS 15, being a SMC company, turnover less than 250 crore, they are not disclosing it, then you need to put one line in the notes to account that this standard is exempted for us and we have taken that exemption. So that's all about the disclosure aspect. Now moving back to the topic of gratuity specifically, first let's talk about the regulation. As we all know that it is Gratuity Act 1972, which is applicable to all the organizations having more than or equal to 10 employees. And one important thing is, once number of employees cross 10, it is applicable always. Like later on, if employee count reduce, still the act will be applicable. Now I would like to ask one question to members, to which you can answer in the chat section, because there is no poll prepared for that. So the question is, let's say some employee have rendered 20 years of service, and let's say his basic salary is very high, say 5 lakh rupees, and based on the 15 days of salary for each year of service, let's say the calculated gratuity amount comes to, let's say, 30 lakhs, for example. Okay, so the question is whether company is liable for 20 lakhs or 30 lakhs. Please type your answer in the chat section, because this is again one of the key questions which sometimes comes from the management, that they have the confusion whether they need to pay 20 lakh or 30 lakh. So I would like to understand from our friends who have joined over here, what is your view, whether it is 20 lakh or 30 lakh? Yeah, so over here also the answer is mixed, 20 and 30. So if we go to the Gratuity Act 1972, the standard says in the section 4 that company is liable only till the maximum amount, which is the 20 lakhs. So there is no legal liability on the company to pay 30 lakhs in this case. But there is a section 4, subsection 5, which says that if company and the employee, they have certain understanding, certain agreement that company wants to pay higher benefit, they can pay higher benefit, but there is no mandatory requirement on the company. The mandatory requirement on the company is only 20 lakhs and not the 30 lakhs, if we talk about the mandatory requirement. But the Income Tax Act says if you are paying 30 lakhs, come here and pay tax on the 10 lakh rupees. because the 20 lakh is exempted and 10 lakh is taxable. So we should not get confused with the Gratuity Act and the Income Tax Act. The Income Tax gives the limit only for the taxation purpose. Gratuity Act gives the limit for the actual payment. Okay, I hope now this is clear to all our participants. So once we speak on the regulation, now comes the accounting. Because once any benefit is applicable to our company, we are following accounting standards for the Ind AS, let's say. The standard says we need to do all the accounting as per the accrual principle. When we follow accrual principle, the standard says under AS 15 and Ind AS 19, you use the PUCM method, make the provision as per the actuarial calculation, and it is mandatory for all the companies, even the small and medium companies. And again, we have understand from the previous slide, we have paragraph 17 AS 15 and 72 in Ind AS 19, that provision is required even if service is less than 5 years. Now, if we talk on the taxation aspect, so the Income Tax Act says whenever we make this provision for the gratuity in the books of accounts, either as per actuarial valuation or in case it is exempted, company do own calculation, in both the scenarios, this provision is disallowed. Whatever provision we make, it is disallowed. It is allowed on the payment basis. So on which payment it is allowed, either we pay the benefit to the employee on separation, or we contribute this amount to approved gratuity fund. Then this benefit is allowed as an expense to the company under section 3615. Over here, one thing is very important to note for our chartered accountant friends, that the standards, the Income Tax Act says it is allowed if you contribute to approved gratuity fund. And there is a part C under Schedule 4 of Income Tax Act, which says that we need to take the exemption from the CIT. So whenever you have the gratuity funding, one need to first set up the trust. And that trust has to be approved by the CIT. Then only any contribution to the approved fund will qualify for this exemption under section 3615. So if you are a tax auditor of your company, if you are the finance controller of your company, then we need to understand that if we have taken this exemption from CIT or not, whether this approval is being done or not, then only this deduction is allowed. Excuse me. I hope this is clear to everyone. Now let's talk about the auditing aspect. So in audit, we have SS 620. The SS 620 says using the work of the actuaries. It says that for the defined benefit obligations, these are the complex provisions. This requires the use of PUCM method, etc. So we need to use the services of the qualified actuary. And they are considered as an expert, and usually we rely on their report. But at the same time, SS 620 passes on some responsibilities on the shoulder of the auditor as well. That, okay, you are using the work of an expert, an actuary, but as an auditor, we also have some responsibility. So it says that we need to ensure that they are the qualified member, they are capable of performing the calculation, and also we need to ensure that the assumptions, the data which is used for this actuarial valuation, they are appropriate, they are reasonable. So this is the duty on the shoulder of the auditor as well, that they need to ensure that the assumptions and data which is used for the actuarial valuation, they are appropriate. So they cannot say that just, okay, we have taken the actuarial valuation report, this is an expert, we rely fully on him. No. We auditor from our side also need to ensure this compliance. So similar to FRRB, we have one quality review board as well. So they had also given certain comments and find some issues in the SA620, which again we will see later on while we move on to the practical aspects. Okay, so we have the issues from the FRRB and from the QRB as well. That's why it is important from the auditing angle that yes, we need to ensure the provision is made, plus we need to ensure that checking is also done appropriately. So both these aspects we are trying to cover in our today's talk. Because first, the clarity is required whether it is applicable or not. Because sometimes it is unclear to us that whether we require this provision or not. In this situation, we end up taking note to make this provision. But I hope this is clear now to everyone that yes, this provision is required, needs to be done as per actuarial valuation. Now coming to the leave actuarial valuations. So if we talk about the regulatory aspect, as we discussed earlier, it is governed by the respective Shop Establishment Act and the Factories Act. And these respective acts have some limits in them, which is prescribed for the carry forward of leave and the encashment of leave. And this is one quick snapshot and summary of those, some of the key acts which I have checked as of now. So if you refer to Maharashtra, Karnataka or Delhi Shop Act, they says that employee needs to be allowed to carry forward the leave up to 45 days. The Factories Act, Rajasthan Shop Act, they say the carry forward of leave up to 30 days. Gujarat Shop Act says limit up to 63 days. So these are some of the acts which given the carry forward limit. Obviously, we have various different states, they have their own different rules. So one can check the respective act. But these are some of the key states which we members from the Western region are exposed to, or our clients may have some venture over there. So if we have this kind of leave regulations, first thing we need to ensure that as a compliance officer in the company, that whether our leave policy is following these rules or not. Because otherwise there can be penalties or issues from the labor department if we don't follow these acts for the leave compliances. Now, when it comes to the accounting part, see, first part is the regulation that we need to provide these benefits, because accounting standard doesn't tell you which benefit to be provided. Accounting standard comes at a second stage. The first stage is the regulation. The accounting comes only if you are complying that regulation. If you don't comply that regulation, then there will be penalties from those departments. But standard says that accounting is to be done when you have these benefits, maybe as part of the legal obligation or the constructive obligation, we are required to make these provisions. I request members not to mention their membership number or the name in the chat section, because the CP attendance will be automatically taken by the institute based on the login. So there is no requirement to mention the membership number or the name in the chat section. Chat section we should use only for our discussion purpose. And questions you can raise in the Q&A portion. Now coming back to the accounting part. So again, accounting is as per accrual principle. We have AS 15 and the Ind AS 19. And as we discussed earlier, it is mandatory for every company and we need to follow the PUCM method. Only thing, the detailed disclosure is not required. The key point over here is this actuarial valuation is required for other long-term benefits. So other long-term benefits means the leave is allowed to carry forward beyond the 12 months from the reporting date. Okay. So once we have the accounting, we move on to the taxation aspect. The taxation aspect says that again, any provision which we make for the leave provisions they are disallowed from the income tax. They are not allowed, but they needs to be done as per the actuarial valuation for the accounting perspective. And if company obtain any group leave encashment policy from any insurance company, then any contribution to such leave policy, it is also not allowed. So any contribution if you make, it will be only on your investment. It will not qualify any tax benefit to the company. For accounting purpose, it may be classified as a plan assets, and you can net off your position at the end of year in the balance sheet disclosure. But from the taxation perspective, there is no benefit of the contribution to the leave plans. Similarly, coming on to the auditing part, again we have the SS 620 and the where we have the comments from the QRB, and we have the issues identified by the financial reporting review board that we auditors need to ensure that they are being qualified. If this is clear, we will discuss one more type of plan, which is the deferred incentive scheme, which is like your long-term service award. So in deferred incentive scheme, what happens? Company is making some commitments to the employee for payment in the future year, and this payment in the future will be linked on some units, and these units are not the equity shares, because if any payout is linked to the equity share, then it is classified as a share-based payment and accounting is done under the Ind AS 102. But if any long-term plan is there in the companies, then this is classified as a deferred incentive scheme or maybe the long-term incentive plan. It is classified as a other long-term employee benefit, and accounting is done as per the Ind AS 19. So one type of example of different units can be the linkage of the benefit to the revenue or the EBIT, or let's say the profitability or P ratio. So company can identify any identifiable measure, and basis that they can derive some units and allocate the units to the employees. And as the growth in the company on those parameters, for example, your revenue increases, the value of your units will increase. So based on the benefit of employee will also increase. So if this is a kind of plan which is given by the company, then this needs to be accounted as an employee benefit in the Ind AS 19 and the AS 15, rather than the share-based payment, because share-based payment of the accounting if the benefit is linked to the share price. So I hope this is also clear. Again, I request members to please not to write this membership number, etc. in the chat section, because it is not at all required to type your membership number in the chat section. If someone is doing mistake, I request others not to do that mistake. Okay, as of now, I have disabled the chat for the members. So if required, I will enable the chat again later on. Thank you. Now we are moving on to the concept of the actuarial valuation assumptions, that how these assumptions are set, or as an auditor or as a company finance controller, we can check or have the discussion on the assumptions. So maybe before I move on this, let me have a quick look at the Q&A section, whether we need to take any question now. Okay, so let us move on to the actuarial valuation assumptions. The first important assumption which we have is the salary escalation rate and the attrition rate, because these payments of the employee benefits, whether it is gratuity, leave encashment, long service award, any pension payout or medical benefits, all these benefits are paid in the future. So it means it have a linkage to the future price of the salary, future medical cost inflation. It requires the use of future attrition rate. So how we can select these assumptions, how they can be used for the valuation. Now, as a general principle, these assumptions are forward looking. Like these assumptions says what is expected to happen in the future years. So as a starting point to set any assumption, one can check the past trend, that in past years, what is the actual increment in the salary, what had been the actual attrition rate in the company. Basis that they can check whether in the future years they can expect the similar trend or not. Now the question may come, how many past years? Whether we take just last year or last 2 years. The answer to that would be, these are the long-term assumptions, and we should check at least maybe 3 to 4 years data to get the credible answer. And when we talk about the future, the question may come, in the next year we have a budget to give 5% increment only, or let's say 20% increment. Whether we should consider that number as a long-term assumption, because the standard says these assumptions are the long-term estimates. And it should not be just based on the future 1 year or past 1 year. As these are the long-term assumptions, there should be some long-term basis for their assumptions. Now, if we want to calculate this number, how we can calculate? Let me take you through to one Excel file with some sample calculation, that as an auditor or as a company HR, you want to check these numbers. Hope you would be interested in seeing the calculations in the Excel as well, like how it can be calculated and so on. Just a second. Okay. So let's say the company is quite large company where they have, let's say, 22,000 employees in the company. So if company is very large, they can bifurcate their employees data in 2-3 different bands. And these 2-3 different bands can be based on the age of the employee. It can be based on the service of employee. So what they can do, for example, we are bifurcating our employees based on the past service. Let's say there are total 22,000 employees at the start of 2021. And out of this 20,000 employee, first we bifurcated that 15,000 are the employee who have service less than 2 years. There are 4,600 employee who have service between 3 to 4 years. And let's say 1,300 employee with service beyond 4 years. And then we can check the status of these employee at the end of year. That out of these employee, whether they continued the organization or they left the organization. Once we have this status that, let's say 6,000 left out of 15,000, so we can have that like 1/3 is the attrition rate. Similarly, we can check this attrition rate for the respective service band. The benefit of doing this kind of calculation based on the services, we can observe in the real life data that employees with the high number of service years, they face the lower attrition rate, and vice versa, employees with the low service, they have the high attrition rate. Because usually employee leaves maybe in the initial years. If they continue in the initial 2-3 years, they tend to continue with the company. This is the general trend we have observed in our analysis, and you might be agree to this based on your experience. So as these assumptions are for the long-term projection, it is better that we do this kind of calculation based on some rational groups. It can be based on age also. Like, for example, employee age between less than 30 years, 30 to 40, so and so forth. So this band we can decide based on the company, how many employees we have. But what is important, there should be some rational band. And let's say one may ask that employees who join the company and leave the company in the same year, whether we should consider them in this kind of analysis or not. So my view is, ideally, we may ignore such employees who are coming and living in the same years. The reason is, as these provisions are for the long term, whether it is for gratuity or leave, and any employee who is leaving within the first 6-7 months, they will not have any impact on the provision. They will not have any substantial provision amount. So either they may be ignored, or we can have a separate column of employee with service less than 6 months or 1 year. Basis that we can do that calculation, because if you clump those employees in the first column of service less than 2 years, it may distort your calculation of the lower service band. And if we are doing the age-wise calculation and includes those employees who joined and left in the same period, this may unnecessarily distort the full company's calculation. So ideally, as a professional judgment, it is preferred not to consider such coming and leaving employees, but we should consider only the continuing employees. Now the question is, as an auditor, whether we are required to do this kind of detailed analysis or not. The thing is, again, it is based on our professional judgment that whether and how much deep we want to do the analysis. We can just do the analysis up to this level also, like there are 21,000 employees and 7,000 left out of this 21,000 employees. Now the point is, if we are doing this kind of analysis, which is very simple to do, okay, and let's say the attrition comes to 34%. Now we need to check our assumption. Let's say if this is the actual trend for last 3-4 years, like in this data we have different attrition of 30%, 27%, and so on and so forth. Now the question is, if this entity uses the attrition assumption of, let's say, 2% or 5%, then that should be questionable to the actuary, or it should be questionable by the auditor, that why the 2% or 5% assumption is used. So it is a responsibility of auditor as well by the SA 620 that we need to ensure that assumptions are appropriate. At the same time, there is a responsibility on management also, because assumptions are the best estimate assumptions of the management. So management cannot hide by saying that it is a responsibility of auditor. Auditor cannot hide from the management. Similarly, actuary can also not hide, because similar to standard on auditing, SA 620, we have actuarial practice standard APS 27, which needs to be complied by the practicing actuaries. Now this actuarial practice standard says, as an actuary, they need to ensure that assumptions are reasonable. They need to comment in that report whether assumptions are found to be suitable or not, they are found to be reasonable or not. So in a way, there are legislation who have given the responsibility on all the three stakeholders: management, actuary, as well as the auditor. So all of the three stakeholders, they have the joint responsibility to ensure the reasonableness of assumption. So that's why these assumptions are very important. How they can play a key role on the liability, that we will see when we see the impact analysis, because now we are talking on the quantum of assumption. I hope this is clear to everyone. And when we talk about the salary escalation, like this is about the attrition rate, we can check. When we do the analysis of the salary escalation rate, we can do based on the amount of salary at the start of year, salary at the end of the year, and calculate the increase in salary in the percentage terms. Now the point is, when we consider any salary escalation assumption, we should give the weight to the opening salary amount, because it may be possible that employee with low salary group or high salary group they may have the disproportionate increase in the salary. So rather than taking the simple average as a professional judgment, it is prudent to consider the suitable weighted average to check the past trend rather than the simple average. And again, it is important, it is not just the past number which we need to take as it is. The assumptions are futuristic. So one needs to discuss with the company what is their future outlook. It is not at all necessary, not required by the standard that assumption is to be same as the past experience. This is only a guide to check. But actual assumption needs to be based on the future expectation what company has. With this, let us move back to our presentation. As we discussed, they can be category wise, like age specific, service specific. We can have different categories of management staff, non-management staff, white collar, blue collar. It can be location specific. It can be short term and long term as well. For example, for next 2 years, company may have budget to give high increment because let's say it is a new IT company. Okay, and they want to retain the employee. They want to give the high increment. So maybe for first 2-3 years, they may have a budget for high increment. So there can be short-term assumption and a long-term assumption. That also accepted. Similarly, we can have age-specific, service-specific that we have already discussed about. So this is more on the assumption, and assumptions are very important. If assumptions are wrong, then the liability will be either overstated or the understated. Let us move to the second key assumption. Okay, before we move on, let us quickly see the chat section as well in the Q&A. The question is, in case of manpower supply company where employee turnover is high and employee leave the job before 5 years of service. The question is, if they leave the service before 5 years, we need to check what is the average attrition rate. So what happens when we make this kind of provision? If attrition rate is high, provision may come out to a lower number, but we cannot say that provision will be zero. So there is a requirement to make the provision for actuarial valuation. That provision needs to allow for the attrition rate. So one can do that attrition rate analysis, and based on that, we can have the higher attrition rate. That's totally fine, because when we do the actuarial valuation of the BPOs, they have the highest attrition rate, like 30-40%. But still, we need to consider that and needs to make the provision. Again, the importance of the categorization may play a key role, because they may have some management staff who may face the lower attrition rate, like 10%, 20%, but the other staff who may face 40-50%. So that categorization is also very important in making the provisions. Now coming on to the next important assumption, which is the discount rate. Because this is one assumption where we actuaries get various questions from the auditors. The first question, which mainly comes on the term of the obligation. So the standard says this term of the obligation, what we have to use is the expected term of obligation. Now on this, let me launch a poll question to our members to select an appropriate answer which is correct in their belief. Let me read the question clearly. The question says discount rate for actuarial valuation is to be based on the estimated term of obligation. Now the question is, this estimated term of obligation, whether it is just simply your retirement age minus current age, like 60 retirement age minus 40 current age. So 20 years will be your term of obligation, or we need to allow for the future attrition rate, future death rate in this number. Let us wait for some time for our friends and other colleagues to give the answer. Meanwhile, I will also show some of the calculation around that. Okay, let me stop the poll and show the results. So interestingly, 40% of our members believe that it is simply the retirement age minus current age. So in our example, let's say 20 years. But sadly, this is not what accounting standard or the index expects us to consider. The standard says this term is an estimated term of obligation. When you say estimated term of obligation, one needs to allow for the future attrition rate. Okay, future death rate. After that, only this term will be calculated. So in any actuarial report, the actuary has to give this estimated term of obligation basis that they have considered the discount rate. And it will not be the 20 years like in our example, it will be less than 20. And how much less than 20, that we will see in our this numerical example. Hope my screen of Excel file is visible. Okay, so what happens over here, that let's say in the company, we have the average age of 40 years and retirement age is 60 years. The death rate is considered as per the death probabilities given by the IRDA table. So from that, we consider the death rate. Now the point is, if we consider 0% attrition rate, then we get this estimated term for expected working life as, let's say, 19.31 years. But let's say the company have the attrition rate of 10% per annum. Then this estimated term will reduce from 20 years to 8 years only. And this will not be 20 years. This will be just 8 years. And we need to consider the discount rate basis this 8-year term rather than the 20-year. Now, say the magic. If let's say company have not done this kind of appropriate attrition rate analysis, and they are just considering the attrition rate of, let's say, 2% per annum, then what will happen? This estimated term of the obligation, this will increase drastically from the 8 years to the 16 years. This is the gap from 8 years to 16 years. And what happens? The accounting standard says we need to consider this number of estimated term of obligation to select the discount rate. Now the question may come from where to select the discount rate, from where to check the discount rate, because as auditors, you are required to check the appropriateness of assumption. So they usually check for the discount rate. So this can be checked from the FBIL. Like we have one website of the FBIL, which is provided by the RBI only. It is a body from the RBI. So from this, we can check the discount rate. So it is a readily available source. It is very easy to check on this number. And I usually suggest the auditors not to rely on any other third parties numbers or tables, but it is better to check the rates directly from the authorized source. It may be other link like CCIL as well, but FBIL is one of the preferred link because it is as suggested by the RBI, and it is also the source which is used by the financial institutions and the bank for the bond pricing from the FIMDA and the FBIL. So how to check this discount rate? Let's say you are doing your reporting date is, let's say, 30th September. So what we need to do on this website, just go to fixed income securities tab. On that, we can select the date. Let's say 30th September we want. So that's how we can just select the range of the dates. And simply we can download this Excel file. And in this Excel file of this GSEC rate, there is a tab of the par yield. So from this par yield, you can select your appropriate term, like whatever is the term of obligation. For that, you can select the annualized rate. So this is one renowned source to check for the discount rate. Now you see if the term is different, the discount rate is quite different. For example, it is ranging from 6.5% to the 7.5%. And if your term of obligation is not appropriate, discount rate will be inappropriate, because there is a linkage of two assumptions, attrition rate and the discount rate. So it is very important to select the appropriate attrition rate first by doing the appropriate assumption analysis, or ask your actuary to do this analysis, which you can just cross-check as a auditor and have some reliance. Because without having this kind of analysis, it will be very difficult to take the appropriate assumptions. And once these assumptions are appropriate, then only this discount rate will be appropriate. Now coming on to our presentation part. So this is the, like I have explained in this, how we can download this, like on FBIL website, we can go and like download this Excel file. We will have one numerical example as well to show the impact of these numbers. Because as of now, what we have shown the numbers of the assumption, what is the impact on liability, that we will also see in some time. Let us see another key assumption, which is the mortality rate post-employment. Because let's say you may have some pension plan for your PSU sector company, like for example, some bank or some other oil industry company or whatever, your PSU sector company. So in that you have some post-retirement scheme, let's say pension or the PRMB, which is the post-retirement medical benefit. So in that, the post-retirement mortality plays a critical role in the provision amount. So what happened in the last year, 21, there was a change in the mortality rate, and the updated mortality rate was published from the IRDA side. And what happened in the new table as compared to the previous table, the longevity has increased. So due to this, there is an increase in the provision. So as an auditor, we are not expected to go into the detail of the calculation, but as an auditor, we need to ensure that the assumptions which are used, they are relevant, they are appropriate, they are latest. So that's what my point over here is, to ensure that the new mortality table for this post-retirement benefit is to be used. And this has a very material impact on the liability, which needs to be accounted whenever this is applicable. And it was already applicable, so it had the impact in the last year. If it is still not used in your case, then you should check in your situation. In case of pre-retirement mortality, we have separate table. It don't have any material impact. That's why I have not given any graph of the new table of the pre-retirement, because it has very less impact on the obligation. So that's why as of now, I have ignored that from this presentation slide perspective. But over there also, there is a new mortality table 2012-14, which was given in the previous years, which needs to be used for the actuarial valuation. Yeah, so now let us take some of the questions, then we will move on to the next part of the calculation example. The question is, can actuarial valuer certificate is to be considered as relying on expert report? Yes, it is to be considered as per SC 620. The next part is, do we have to mention the detail of name and firm in the annual audit report? No, it is not required. The name is not required to be mentioned. The next question, but at the same time, you can rely on the expert report as part of SC 620. But as we discussed earlier, SC 620 gives two responsibility to the auditor. One responsibility, qualification of the actuary. Second responsibility, appropriateness of assumption. We will see that again in detail when we go on the practical aspect. The next question is how to know the period to take while downloading the file. This is very good question. The period will be mentioned in the actuarial report as an estimated term of obligation or as an expected future service, something like that they must have mentioned. And again, this will not be 20 years in our example, like 60 minus 40. It will always be less than 20. If it is 20 years, it means attrition rate is 0%. Okay, so that we need to ensure that this period is just not a simple difference. It is based on the future attrition, future death rate, because para 78 of the AS 15 and para 83 of the Ind AS 19, it says as it is an estimated term of obligation. Okay, so we need to ensure that aspect as well. The next question is, do we need to disclose the assumptions considered by actuarial valuation report in the annual report? The answer is yes. We need to disclose the assumptions even for the small and medium company. For large companies, obviously, yes, they need to give the detailed disclosures. But for the small and medium companies also, having turnover less than 250 crore, they are required to make the provision as per actuarial valuation, plus in the notes to account, disclose the assumptions and the provision amount. The detailed disclosures are exempted, but some small disclosures are required for assumption number and the amount of provision. These are the two requirements for the small and medium companies. With this, let us move on to the calculation example, because what we have discussed so far was kind of a theory with some practical. Now we move on to the calculation part. So let's see, we have one employee with a salary of 1 lakh rupees and currently his age is 30 years. And past service in the company is 2 years, plus retirement age of 58 years. And company follows the gratuity act, so it is up to the cap of 20 lakh. Now, as part of the actuarial valuation assumptions, they have taken certain assumptions like the discount rate is 6.90%, salary escalation rate of 8%, mortality table is ILM 1214 and the attrition rate of 10%. So when we do the, let's say this is the only one employee in the company for the time being, because what happens, the calculation of the actuarial valuation is done on the individual employee. Then we club the number of liability and give as a total provision in the company. The calculations are done on the individual employee, but assumptions are applied at a whole, that everyone have this assumption. So what we do in this kind of case, first we calculate the accrued amount, because we follow the accrual principle, that what is the amount we need to pay today if employee leaves the company, what is the gratuity amount. It is based on 15 days of salary for each year of service, which is 2 years, and the monthly salary is 1 lakh, which is divided by 26 to arrive at the daily salary. Okay, so based on this formula, we get 1,15,000 as our accrued amount of gratuity. As per the PUCM method, what this PUCM method says, you need to project this amount in the future years till the retirement age. Then apply the probability of paying this amount in the each year and come up with the expected payout amount. What we need to pay as a benefit, then take the present value. So in nutshell, if I say in one line, actuarial provision liability, this is the present value of future expected amount of the accrued benefit. So we have the accrued amount, we project this benefit till the retirement, we calculate the expected payout in each year, then take the present value. Let us see with some numbers. So we had this 1,15,000 at the starting time. project this 1,15,000 till the retirement age of 58 years by applying the salary escalation rate, which was 8% in this scenario. This is for the accrued benefit. Accrued benefit was your 2 years of service. Once we have this projected accrued benefit, we apply the probability of death, probability of attrition rate. Based on that, we calculate the expected payout amount. So once we have the expected payout amount, we calculate the present value. Now I have a question to our members, to which you can reply in the chat section. Now chat is enabled for everyone. My question is, in the first 3 years, why this amount is very low, like 100 rupees only? But in the later years, it is very high amount of 10,000 and so on and so forth. But in the first 3 years, why it is a very low amount? This is the question. Please type your answer in the chat section. I request members not to type their membership number in the chat section, but type your answer in the chat section. Because typing of the membership number is not at all required. Yeah, one member have given the answer, which is very right, that 2 years of service is already done, 3 years are pending. So if employee leave the organization in the first 3 years, before the 5 years completion, then he get nothing. But at the same time, if the death happens in the first 5 years of service as well, then also we are required to pay the gratuity. So that's why there is some death probability. To account for that expected death payout, there is a small amount of expected payout on death, but payout on the attrition is 0. That's why we have very low cash flow in the expected payout in the first 3 years. And once we have this expected payout, actuaries take the present value by considering the discount rate and arrive at the present value, which is recorded as a provision. So consider this situation. The accrued amount was 1,15,000, but the present value of this is 94,000 only, based on the expected payout, because we have the future attrition rate, we have future salary escalation rate, we have the death probability, attrition rate, so on and so forth. So it is not just the 1,15,000 multiplied by 70%. It is a proper calculation by applying this attrition rate, death rate, salary escalation, etc., everything. Then this amount is arrived at. So this is the key point what I wanted to highlight over here, that this provision is very important and dependent on the attrition rate. And now let's say this is your client. You would have considered that before 5 years of service, we are not required to make the provision. If this was the thinking before, earlier by the company, then your provision amount, your balance sheet provision were understated by this, because as per accounting standard, we need to make this provision in our accounts. You cannot say that I will make the provision when employee leave the company, I will account for the expense what is paid to the employee. That will be a cash basis of accounting. As we auditors, we need to ensure it is a accrual basis of accounting. Provision is made as per the accrual principle. Now let us see some of the impact of these assumptions and the calculations. Let us see that if this company would have taken the attrition rate of 5% per annum instead of 10%, what is the impact on the liability? With 10% attrition, we have seen that provision was 94,000 rupees. But what happens when you change the attrition rate from 10% to 5% for this kind of employee? What will happen? Logically, if we talk, if attrition rate is less, it means this employee who have serviced less than 2 years, this employee have more chances of completing the 5 years, more chances of getting the benefit. So your provision will ideally increase for this employee. Now, how much is the increase or decrease that we will see now? So what is happening when you change your attrition rate from 10% to 5%, the discount rate also changes. That we have seen in the previous slide, previous discussion in Excel file, that if you change the attrition rate, your future term will undergo change. Okay, with the different term, we have different discount rate. So what is happening in this case? This is considering the discount rate, which is, let's say, on the 31st March 22 for this example. Okay, and by reducing the attrition rate, your term has increased, and for that higher term, you had the higher discount rate. So now, basis this situation, your attrition rate has reduced, so your payout in the future years have increased, like, because it means that employee will continue the organization for a longer period. And due to this, what is happening? Your provision is increasing significantly. Like earlier, your provision was 94,000. Now it has moved to 1,10,000 rupees. So this is a very significant increase, you can say, in the provision amount. So that's why it is very important to understand that assumptions are appropriate. We cannot blindly say that increase or assumption or decrease of assumption will like increase your liability or decrease your liability. It will depend on the facts and circumstances of the case, because different employee profile, whether employee have already vested the benefit or not. So that may be a different question in itself. But the point over here is it have a material impact because assumptions are interlinked. Yeah, so I hope it is clear to everyone that why we have the lower expected payout in first 3 years. The reason is attrition payout is 0, but death payout is there. When we have the death payout, death rate is very low. That's why the amount of this expected payout is very low in the first 3 years. Now consider another change in this plan, because there is a new social security code which says that for a journalist employees, the vesting period will reduce from 5 years to 3 years whenever this act gets applied. Okay, so let's say in this situation, if you reduce your vesting period from 5 years to 3 years, what will be the impact? Okay, so what happens in the first 3 years, we had that very low payout. But if your vesting period is 3 years only, then what will happen in these 2 years also? You will get some payout if you leave the company. So that's what we can see. The expected payout with a vesting criteria of 3 years. Now employee will get the payment if he leave in the 4th and 5th year as well. Okay. So basis that now as the expected payout has increased, my present value will also increase of the total benefits, which has increased from 94,000 to 1,14,000. So again, whenever this change comes for the journalist employees, where the vesting period is reducing from 5 years to 3 years, this will have a material impact if the company have the employee with service less than 5 years. If let's say the service is already completed that 5 years, then this will have no impact because they are not impacted by the decision. So I hope this is clear to everyone. With this, we can move to the next concept of the practical aspects of the actuarial valuation and some of the auditing points. So basically these amounts, all these calculations are done by the actuary. What I'm trying to show over here is how this is done, so it doesn't remain to be a black box that how it is done. Okay, so that's why with this idea I'm showing you, and the key reason why I'm showing you is to show the impact of assumption. The reason is SC 620 passes on the responsibility on the shoulders of the auditor. They need to ensure first the provision is made. Second, provision is done by appropriately by the actuary. Third, they say it is done by the reasonableness of check of the assumption should be done. So that's why we are discussing all these points. And similarly, the accounting standard passes on the responsibility on the management. So if you are working as a role of the finance controller or the CFO in your organization, then also it is very important to have this conversation with your actuary. Now let us see some of the practical aspects of actuarial valuation. The first one is, the question comes whether we need to include the directors or not. The answer to this would be, we need to include the directors. They are also employees. So we need to include the directors and they should be part of your provision amount. But at the same time, we have rules in the income tax. So if you are having the gratuity as your benefit, which is funded by the any insurance company or some trust, then what happens that whoever director you have, if they have shareholding more than 5%, then such director is not part of that fund. This is given under the rule 101 to 104, which are applicable for the gratuity funding purpose. So this needs to be ensured that directors are included in your provision data. But when you do the funding with maybe insurance company, then check the 5% shareholding. Because otherwise, as a tax auditor, we need to check that compliance can disallow that particular part and there can be other repercussions. The next is Ind AS 24 disclosures, or you can say AS 18 disclosures. So the standard says in that AS 18 or Ind AS 24 for the related party, we need to disclose the KMP expenses. So that also needs to be disclosed for the post-employment and other long-term plan as well. So one need to ask their actuary, respective actuary, to give the specific employee that specific KMP's expense amount to be disclosed. The next point is on the benefit scheme. As a auditor, we need to ensure that benefit scheme which is used in the actuarial report and the policy of company, they are same. That we need to ensure. The next one is on the current and non-current liability. So when we have the unfunded plan, let's say we don't have any funding with any insurance company, then what happens? The current and non-current provision bifurcation of the defined benefit obligation, that will depend on the whether benefits are expected to be paid in the next year or not. Whatever benefit which is expected to be paid in the next year, it is classified as a current liability and balanced as a non-current liability. The tricky part comes in the funded plan, where I have seen some kind of issues in some of the financial statements, and it has been observed sometime that standard says this bifurcation of current and non-current needs to be given for the net defined benefit obligation, which means your gross defined benefit obligation less your plan assets. So whatever is your net defined liability, of that we need to give the breakup of current and non-current. When we make this breakup, the current liability will be expected contribution amount in the plan assets in the next year. Whatever amount you want to contribute from the company to that fund, that will become your current liability, and balance of the net liability will become your non-current liability. So that's the one of the practical aspect that we need to ensure while doing the audit of this kind of provisioning. Yeah, so there is a one question from the one member on the actuarial gain loss. Let us first see one poll question on the same, then I will explain that concept. So we have the question that in case of Ind AS 19, where we have the requirement of the OCI, the question is for the post-employment benefit obligations, the actuarial gain loss, it is recognized in PNL or the OCI, or there is a choice available, like you can do any place wherever you want. So it is a Ind AS 19 post-employment plan like your gratuity and your pension or PRNB, where you will recognize your actuarial gain loss, PNL or OCI. Okay, so this is to also inform the members, like we may need to extend the session for next 15 to 20 minutes at least, because to cover all the aspects. So I hope it is okay to our members. So again, over here, the answer is like quite distributed, that half of the members believe it is to be PNL, half of the members believe it is to be OCI. The thing is, if it is Ind AS 19, all the actuarial gains and losses of the post-employment plan, they needs to be recorded and expensed out in the OCI rather than PNL. So this is a requirement of the Ind AS 19, that actuarial gain loss for the post-employment plan, this needs to be recorded in the OCI rather than PNL. Similarly, we have one more poll question on the actuarial gain loss of the other long-term plans. See, other long-term plans like your leave benefit or the long service award, the question is, if it is a other long-term plan, the actuarial gain loss in case of Ind AS 19, you need to record where? The PNL or OCI. I again request members, please don't type your membership number in the chat. It will not add any value to your attendance. There is no benefit of typing the membership number in the chat. Okay, let us see the answer of the poll question. So over here, the majority of members have selected the PNL, which is the right one. That in case of Ind AS 19, if it is a other long-term plan, then such actuarial gain loss we need to record in the PNL rather than OCI. This is one of the issues being found in some of the annual reports of some of the listed companies as well, where they have disclosed in the accounting policy that actuarial gain loss is recognized in the OCI for the other long term, which is wrong. The standard in the para 155 of Ind AS 19 says we need to record such actuarial gain loss in PNL account. And there is no requirement of OCI in case of other long-term plans. So I hope this is clear to all our members now on actuarial gain and losses. The next one is on the key aspect in the leave encashment. So when we do the leave actuarial valuation, there can be different limits for the leave encashment and leave availment. Like leave policy may say that employees are allowed to carry forward, let's say 60 days of leave. They can avail such 60 days of leave, but encashment is allowed only for 45 days. So actuarial valuation needs to consider these different limits. There can be different salary, like encashment is on the basic salary, let's say, but leave availment needs to be valued on the CTC salary as per the requirement of the accounting standard. There can be other practical aspect of the employee transfer, like employees are transferred from one group company to another group company with continuation of service. So in such case also we need to record such transfer of employees and record it as an intra-group transaction. The next one is on the plan assets. If you have funded any with your approved trust fund, then for such plan assets, you are doing the year-end accounting or let's say the quarterly reporting. And you get the statement from the insurance policy, but insurance company have a system to add the interest maybe at the end of the year, or at the end of year also they may take some time to declare the interest rate. The question may come whether we include the accrued interest for that particular year or not. Ideally, we need to include that accrued interest part for the period till the reporting date. Because as we are following the accrual principle, we should add that accrued interest part. Then we consider that plan assets value. Similarly, if trust have some bank account, such bank balance needs to be included in the value of the plan assets. Now we have the important aspect which you all must have been waiting, is the common errors found by the financial reporting review board. So some of them we have already discussed, but let me rephrase it. The first of the important issue which they found was non-provisioning of the gratuity, which is an issue of the matching principle. The accounting standard requires company to make the provision when service is rendered. We need to account the expense in the period when revenue is recognized. So this is the matching principle. So what happens that company have not made the provision? This is one of the key issue which was identified. And now we all are clear. We need to make the provision for gratuity from the first year itself rather than waiting for the 5 years. The second one was inadequate disclosure or no disclosure for the post-employment plan. The standard have given the detailed disclosure requirements for the listed companies, or you can say the non-SMC company, which needs to be given. And for small and medium company, the assumptions needs to be given as a disclosure. So those disclosures were missing in some of their cases. In some of the cases, the issue was defined benefit was wrongly treated as a defined contribution plan. So this is an example of the exempt PF trust fund. In case there is an exempt PF trust, when company contributes to this PF trust, and from this PF trust, they manage the employee provident fund. So this kind of PF fund is classified as a defined benefit plan rather than defined contribution plan. The reason is there is an interest rate guarantee that the trust needs to match that guarantee, and if the earning of the trust is lower than the EPFO rate, company need to contribute to match that shortfall. So there is a interest rate guarantee. That's why it is a defined benefit plan which requires the actuarial valuation. The another issue which was found was non-disclosure of expense of defined contribution plan, which also needs to be disclosed for the amount of PF expense, let's say the PF contribution expense, if your contribution is with the EPFO. Because if you have the PF trust, then it is a defined benefit plan. If you have the PF with EPFO, which is the maximum situation, then it will be defined contribution. The next one was the inadequate disclosure of the PUCM method. Now let us move on to the issues which are found and given by our QRB. So they have highlighted two issues with regard to SA 620. The one says there was an issue that not evaluating whether the actuary have the necessary competence, capabilities, and objectivity. So this is what required by SA 620, but this was found that this was not complied by in some of the cases. The another issue found was the reasonableness of assumptions and method used. It was not evaluated. This is the second issue which was highlighted. So how we can mitigate these two things? The possible mitigation is, as an auditor, one can check for the qualification or the COP of the actuary who is working on that particular work, because as part of the Actuaries Institute, we issue the certificate of practice, which is required by the fellow actuaries. And similar to the ICAI, in case of Institute of Actuaries of India, where they issue the certificate of practices, the companies are not allowed to practice. Only the proprietorship, individual, and the partnership have this practice. So these things of the compliance needs to be ensured by the auditor with regard to SA 620 on the first part. The second part was on the reasonableness of assumption. Over there again, yes, we need to check for the reasonableness of assumption. This should be done. It may be the overall level by the auditor, but at a granular level, they can ask the actuary to do this kind of analysis and check the results of the same at an overall level. The example of this work we have already discussed, like when we see various annual reports, like we could see that various companies may be following the attrition rate of 1 to 3%, but actual can be 15%, 20%, or 30%. So this is the one case one needs to ensure as a auditor that assumptions are reasonableness. They should be reasonable. It should not happen that actual and expected are so very. For example, the actual increment of the salary in the company is, let's say, 8% to 10% to 12%. But assumption is only 4 or 5%. So this is what, as a auditor, we need to ensure that in our cases, these non-compliances are not there. This is a small snapshot of the Social Security Code, although it is not applicable now. Like whenever this comes into play, the one change is in the definition of applicable salary, which changes from current basic plus DA to the wages. And for working journalists, as we discussed earlier, the vesting criteria reduced from 5 years to 3 years. And for working journalists, this fixed term contract employee, there will be no minimum vesting criteria. So as of now, this Social Security Code is not implemented, but whenever this gets implemented, these are the key changes in the Social Security Code with regard to gratuity. This is one like entry for the liability transferring out for the intra-group that you may see later on. This is a simple accounting entry. The concept we have already discussed on this. One sample report I will show once I finish this thing, some of the audit checkpoints. So if we talk about the audit checkpoints, so I have given this sample checklist, which as an auditor, you may want to use. Like one is, we need to ensure that whatever provision we are making, it is in line with the company policy, whether it is with the limit or it is without limit. If it is a leave valuation, whether there is a limit of any carry forward of limit or not. So we need to ensure that the provision is as per the policy of the company. Then we need to ensure the employee data, the cutoff. Like data has to be as on the reporting date. Let's say the 31st March rather than the in-between data. It should include all employees, irrespective of service less than 5 years. We need to include the directors. And one important point is the valuation table which you may receive from some insurance company, like for example, LIC. This is not the AS15 report. So this is the funding valuation. For accounting, we need to do the valuation as per the AS15 or Ind AS 19, which is to be done by the actuary. The other key points are like there can be due but not paid liability. For example, while we consider the end of year data, there can be some employees who left the company but payment is pending. So such due but not paid liability needs to be considered. There is also treatment for the liability transferring out, like we discussed earlier. Then ultimately we need to do some kind of variation and the variance analysis from the last year to previous year, that how much is the expense increase or decrease. Usually the actuarial gain loss amount, that is usually the variation in from the years to years, because 1 year there can be actuarial gain, another year there can be actuarial loss due to the movement of discount rate. But this is a macroeconomic factor, may not be in the control of company. But there is an item of actuarial gain loss due to experience adjustment. That actuarial gain loss due to experience adjustment, that speaks about the key reason why there is a difference between assumption and actual. So that we need to ensure that this actuarial gain loss is a minimum. due to experience. If it is very high, then it may be a time to check for the change in assumption. Then lastly, the use of SA 620 which is given by the SA 620. Now we have some of the opportunities for chartered accountants in this, which I feel there are some opportunities for chartered accountants as well. One is that wherever we have the group gratuity for the funding purpose, it requires the setup of trust, audit of the trust on a yearly interval. So there is a immense opportunities for chartered accountants in this field of the employee benefits for the setup of trust and the audits of the same. Similarly, whenever you do the funding from the insurance company, so it is like other investments. So for your clients, you can have this kind of insurance policies under the trust. So these are some of the opportunities over there. Another opportunity is with regard to getting into this profession, because this actuarial work requires the actuarial qualification. So if as a CA, you also want to pursue this profession, then it is one of a very good profession, because there is a huge demand supply gap of the actuaries. Because as we have seen now, this actuarial valuation is required by all the companies, all size of companies, where it is possible that as of now, some of the companies may not be taking the actuarial valuation because of lack of awareness. But now, as an auditor, as we know that yes, it is required by all the companies, there is a huge demand for the actuaries in the field of employee benefits and also in the field of insurance, where the IFRS 17 is also coming. So there is an immense requirement of actuaries, and the supply is very limited. Like in India, as of now, there are only 500 actuaries. So to fill that demand supply gap, CAs are a good professionals who have the knowledge of finance, and if they want, they can enter into this profession. And also, which may not be aware to various of our members, CA can also do the practice of actuary, subject to he himself is a CA, because as part of the MDP, they cannot be partner, but as an individual, if you are both professional, then they can do both practice at the same time, but not of the same client. So these are some of the professional opportunities being available to our chartered accountants in this field. So this is all from my side on this topic. If you want to see some of the sample annual reports, I would better give you one link from where maybe you can see. This is a link of the WIRC only. So in maybe year 2020 and 21, they had done this project where they had collected the information of various Indias at one place in a single Excel file. So you, in the search item, you can type your index, whatever you want, maybe index 19 or whatever index you want. Let's say 19 we want. You can click on view more and you can download this Excel file. And this Excel file will have a detailed disclosure under the index 19 for the various listed companies, 30 plus listed companies you can see in this disclosure. If you see any the disclosure, you will find the paragraphs for the significant accounting policy. And then you will find the item of current and non-current, movement of actuarial gain and losses, movement of liability from start of the year to the end of the year. So on and so forth. There are various disclosure requirements in this. So as such, these disclosures are being provided by the actuaries only in their actuarial report. But we auditor needs to ensure that they are being appropriately disclosed in the financial statements One issue which I have observed sometimes while checking some of the annual report was like while they disclose the numbers like this for the actuarial gain loss. I'm not saying this one is the wrong, but I'm saying the type of error which may be happening. For example, the actuarial this experience gain loss amount. One need to understand the bracket and the importance of bracket. Like gain is mentioned in the bracket over here and loss is without bracket. So we need to ensure that the same bracket is following over here. Sometime for some of the listed company, for the large cap, I can say I have observed that this type of error has been found. So as a auditor and the company, we need to ensure that while we take these disclosures from the actuarial report, it needs to be appropriately disclosed. Last but not the least, the one which I had thought of to show was one of the simple LIC report. Like this time it gets a question from the auditors that we have this kind of LIC reconciliation table. So whether we can consider this as a AS15 report or not. So if you go to the last of this kind of report, they themselves have clearly said it is not a AS15 report. The reason is there are various points which I have given in the audit checkpoints, let's say. This could be the reasons. That's why they know there are gaps. And they have mentioned it is not a AS15 report. Because for accounting purpose, we need to ensure all those compliances, the data cutoff, the assumption reasonableness, and so on. The reason is, if you check any LIC report, they would have the attrition rate assumption of 1 to 3%, but actual would be different. And again, the data cutoff. So there are other reasons like directors' data, etc., are also there, but still they themselves know it is not AS15 report. That's why they have given a disclaimer in that report. Now, any question is there to any member? Let me see the Q&A section. Yeah, one question was from Mr. Uday. Yes, the person can do both practice given that he himself holds both qualification. Another question is, are all companies are required to get done valuation compulsory from a practitioner? As per accounting standard, yes, all are required to do it from the actuarial valuation. But at the same time, the accounting standard says it is recommended to done by actuary, but the auditing standard says it is to be done by the qualified actuary. But if you go to the accounting standard, it says if you are not doing from the actuary, then you need to ensure all those compliances needs to be done. The PUCM method, assumptions, etc. That's why they say it is recommended to be done by an actuary. The question may come that whether we need to do quarterly or yearly. So the index 34 doesn't require a specific quarterly actuarial valuation report, but if the benefit amount is material and it is a listed entity, then it is preferred they obtain the quarterly actuarial valuation report. Otherwise, it is not mandatory to perform the quarterly actuarial valuation report. Yeah, the link of data, let me share in the chat section. First, let me, okay. Let me select everyone. Just give me a second. Let me first block the chat for other. I don't know why members are writing the membership number. What is the hurry for typing the membership number? Because this is not at all required. Okay, so the link of the website I have already pasted in the chat section. Okay, the one question is, LIC is giving advertisement in the newspaper that their leave scheme is eligible for IT deduction. So one may need to ask the LIC why they are giving such advertisement, because you are also tax expert, I believe. So from the taxation perspective, in the income tax, it is not allowed for the income tax deduction, but That's up to them what kind of advertisement they are giving. Can we get the presentation? Yes, presentation will be uploaded. Is the audit of gratuity trust mandatory? Yes, gratuity trust needs to be audited and return needs to be filed under ITR 7. Okay, any other question member have? They can raise the hand also. I can like unmute them for maybe 1 or 2 members to ask the live query. First, please type in the Q&A section. Do you have a query? Because I can see some of the members have raised the hand earlier. Okay, let me unmute to Khushbu Raka. If you have any question, please ask Miss Khushbu Raka. Okay, it may be by mistake. Let me go to another member, Mr. Santosh Mehta.
Can you unshare your screen? Then we can. Yeah.
Yeah. Okay. Okay, fine. If you have any question, let me go to again to Q&A section. Yeah, if the employee count is less than 10, then the gratuity act itself is not applicable. But if company voluntarily follow the gratuity benefit, then the provision as per the AS 15 or Ind AS 19 will be required. I will ask her to unmute Mr. Vora. Okay, I think we don't have any further question. Yes.
Kartikey, there is a question that in their link, the data is older than 2020. Can we get the latest information till March 22?
Yeah, Sagarji, actually, I agree. This is a old data till 2020. But this was one program run by the WIRC earlier as a project. I understand this takes a lot of time and effort to prepare this kind of data. So as of now, I'm not sure whether this kind of analysis of the 22 is available. But from the technical perspective, if anyone wants to study any Ind AS or want to have any particular expertise, they can check this data because the concepts are more or less similar. So this is still helpful. Let us take 1 or 2 last questions from the Q&A section. A company has a gratuity trust and recognizing its gratuity obligation as per Ind AS 19. Whether the gratuity trust is also required to incorporate actuarial valuation in the books of accounts. So what happens for the trust? The liability is what is money received by the trust. And as such, there are no specific Ind AS or AS being applicable to the trust. So it is up to the trust how they are doing the accounting. The one way of experience which I have seen and found reasonable is that whatever money you have received as an investment, you show that amount as an asset side and similar amount in the liability side. Another way is whatever actuarial liability you have in the company's books of accounts, that you show as a members corpus liability amount, the balance as a receivable or payable, and on another side you have the assets, which is your investments. So this is another way of presentation, but otherwise the Ind AS 19 or the AS 15, that doesn't apply to the trust. Okay, there is a one question. Is there any change in the minimum service of 5 years? As of now, there is no change in 5 years rules. It is 5 years only, but in the future, whenever social security comes into play in the future, that time, these 5 years requirements will reduce to 3 years for working journalist and 0 years for the fixed term contract employee. But otherwise, for other regular employees, it will be 5 years only. Yeah, it is again compulsory for non-corporate entities also based on their turnover borrowing criteria, whatever we have seen level 1, 2, 3, 4. So I hope this is, we have answered all the questions.
One last question. Can you take, Kartikey?
Yeah.
If company takes group gratuity policy of an insurance company, then tax deduction allowed or not?
Yeah, it is allowed if you take it under the group gratuity. For example, I have a company ABC Limited. I purchased the group gratuity policy directly from the insurance company, let's say Tata Life Insurance Company. The question is whether this policy will be allowed for the tax deduction purpose or not. Answer is no. The reason is 3615 says it can be allowed for the taxation purpose if it is via the approved gratuity fund. So first, we need to set up the trust. Under the trust, we need to purchase this policy. So if you purchase the policy in the name of ABC Limited, it will be your normal investment only. It will not be 3615. It will not be contribution to approved gratuity fund. To qualify for approved gratuity fund, it has to be via the trust. And there, on that we have the Part C under Schedule 4 of the Income Tax Act. Yeah.
Thank you, Kartikey ji.
Yeah.
There are lots of questions right now also.
Yeah.
I think
so
you had
maybe
answered.
if any member have any question later on, they can connect me separately one-on-one, because you see, this is an endless topic which can go on, and so at some point in time we may have to put a break. So this is my contact details which are shared on the screen. So you can connect with me later on for any discussion on this topic one-on-one. Thank you very much.
Yeah, I think you have answered more than 50 or 60 questions you have answered already. And there are more questions in the chat box. It shows that participants are more want to know about this actuarial valuation, and the way you presented the topic, it make it this topic more interesting, I think, guess, because you have involved all the participant in your presentation. Like you have taken pool also, so they've awakened.
Correct.
So thank you. Yeah, thank you, Kartikey ji. So with this, I want to request CA Pooja Jajal to give a formal vote of thanks to Kartikey ji. You are on mute, Pooja, you are on mute.
Okay. Good evening, all. Am I audible?
Yes.
Good evening, everyone. It has been an immense pleasure and an honor to be a part of this virtual program organized by WIRC of ICAI. I want to thank CA Kartikey Kandoi ji for giving in-depth knowledge of regarding the actual valuation in employees' benefit. They have touched upon the detailed aspects of the regulations, accounting, how to do, how it impacts on it has impact on taxation. They have also given a sample report, and they have shown us the calculation, how to do calculation on these valuation aspects, and they have given us the practical also knowledge, how it works, this actuarial for this employees benefit purpose. And thank you so much, sir, for giving us this in-depth knowledge. And then I want to thank CA Sweta Jain, the Secretary of ICAI, for giving introduction and for starting the session and addressing the virtual program. Then I would like to thank CA Pinky Kedia ji, the Regional Council Member of ICAI, and also this today's Master of Ceremony for conducting smoothly and patiently the entire virtual program. And last but not the least, I would like to thank all the members. More than 600 people have registered, and they were actually participated in this virtual program. So I would like and give a round of applause to them for participating in this virtual program. Without them, it won't be possible, and it won't be as successful like this. Thank you so much. Thank you, everyone.
Thank you, Kartikey ji.
Thank you very much. Namaste.
Thank you, Kartikey ji.
Thank you.
Thank you,
Thank you
Pooja.
and good night to all the members.
Thank you, ma'am.
Yeah.